In today's video, we're going to go over tax-advantaged Roth IRA accounts and the top 5 funds, according to this article here, that are best suited for Roth IRAs. Now, why does it even matter, right? Taxes suck. That's partially why having a tax-advantaged account is very good. Also, when you're looking at investment choices, a lot of times the tax implications of said investments are often overlooked. And what I'm going to do today is break down those 6 funds, and I'm going to talk about the top 5 holdings and also which one is suited for more of the beginning IRA contributor. And then the last 3 will be for those people who are taking money out of their Roth IRA and thus need better income. And we'll go over a little bit about taxes. One thing to remember is I am not by any means a tax advisor or financial advisor, so take all of this for fun and refer, of course, to your own investment philosophy and thesis when you are making these investments. All right, so let's take a look. So here on this slide, you'll see we're talking about the fund, the top holdings, and how they compare against the market. And for this, the market, I'm going to use SPY. We can't directly invest in the S&P 500, but the SPY, managed by State Street, is probably the closest thing and most liquid ETF we have in this space. So here is the SPY. It has an expense ratio of 0.95%, and here are the top 5 holdings. As you can see, it's done phenomenally. Right, SPY year to date is 22.41%. Microsoft is up a whopping 58%. Apple 47.19%. Amazon 75%. Nvidia 220%. And Google with an L is up 49.45%. And again, this is as of November 30th, 2023. Now with SPY, you can invest with as little as $5, so it's a pretty good deal if you are trying to just start off and you had a Roth IRA account at Webull or at a lot of these other places that you can get fractional shares. Now Webull is the one that I use, which you can get fractional shares at just $5. So first on our list, we have VOO, which is Vanguard's version of the S&P 500. Now what makes this one more attractive than SPY is its very, very low expense ratio. Check that out. Its expense ratio is just 0.03%, which is a third of the SPY. Currently, as of this date here, which is further in the future than the chart you saw earlier, it's about $422. Now its yield is 1.48%. That means its dividend kickoff, the amount you get, is 1.48%. This is the total return as of this year to date, and the total return is 22.53%. So if you had $10,000 by the end of the period that we measured, you'd have just over $2,000. Pretty good investment. Here is how it compares against the SPY. It is doing a little bit better. Could be because of the mixed little bit of their holdings, or it could be that their expense ratio is lower. We can't really compare that too close because these things change and there could be tracking errors as well on VOO. Now there we go. Its top 5 holdings are almost identical to SPY. Actually, it is identical. The only thing different is the weighting, whereas the SPY has more Microsoft shares as a percentage of the entire fund. This one has a little less. All right, next on our list we have QQQM. Not to be confused with QQQ, which is the normal way that most people who follow the stock market invest in the NASDAQ. Now this fund is the same exact makeup. The only difference is the expense ratio's a tad bit lower. And the reason why they created this is to compete with, of course, the massive Vanguards and Fidelities of the world, so that the buy and hold investor could also participate and buy products from Invesco. Invesco's QQQ option is a bit more I guess you'd call it liquid. Also, it trades a lot more, just another way to say liquid, and there are more options that you can buy on the QQQ over QQQM. But for people, especially those who just buy and hold in their retirement accounts, this would be a good option, an alternative to QQQ. If you have QQQ, switch it up to this, be primarily the same. It has a yield of 0.62%. and an expense ratio of 0.15. The QQQ has an expense ratio of 0.35, I believe, which is higher. Here is the total return of QQQM over the measuring period, which is the beginning of the year to the end of November, it is a massive 51.39% gain. So if you invested $10,000, you'd have a whole bunch more money, about $14,548. Now, how does it compare to the SPY? Definitely doing pretty good. It has a higher expense ratio than the market, 0.95%, especially if you use VOO, much higher. But its return is also much higher in this case because its heaviness in technology. So its top holdings are Apple, Microsoft, Amazon, Nvidia, and Meta, otherwise known as, or used to be known as, Facebook. So those really pushed up QQQM's return this past year, and its top 5 positions make up almost 20% of the 100 stocks that are in the NASDAQ 100. Its beta over the 5-month monthly average is 1.17. That means it fluctuates a little bit more than the last two, as if it was just one, it would be only the market. And I only mention it now because the last two were pretty much identical. Next on our list, we have AVUV. Very different fund. It's kind of like that kicker in here that I put in just so that we could give some diversity to the overall investment portfolio for your 6 picks. Now, AVUV is a small cap value ETF, which is kind of strange because small caps are typically smaller companies, and value you kind of ascribe to a more larger, sturdier company. But nonetheless, we do have a ETF that covers both the small cap that are value centric stocks. This one has an expense ratio of 0.25% and a yield of about 1.83. It doesn't trade too much, but it is definitely liquid enough for you to buy and hold. Now here is the total return over the measuring period. It's about 9.57%, about half of the SPY, but also if you notice, this is a small cap fund, and most of the funds, at least the returns for SPY, were based in tech, big tech. So that's why this fund not so hot as far as the returns compared to SPY. And you can see it more visually. They have a lot more funds, as the top 5 only encompass just a little less than 5% of the entire fund makeup. And most of these stocks, I'm sure many of you haven't even heard of. That's the ticker symbol there. You can go check it out by stopping and screenshotting this, or go and look on your Webull app to see what these funds are, or these stocks are. But they hold a lot of smaller companies, so they might not be who you'd hear of every day, and it might be a good way to diversify what you've already got in your Roth IRA, because most people already have SPY, QQQ, some of those things, VTI. So this would be a good way to bring some diversification to your portfolio. Its beta is only 1.03, so it kind of moves with the market, so it's not going to be one of your huge swinging investments. Now, a little bit about taxes. So the next 3 ETFs I'm going to talk about focus on interest or dividends, some way of getting money that comes out every single quarter. And that's the driver, that's the strategy of the ETF. The last 3 that we talked about, you're primarily going to be looking at capital gains. So what does this even make sense? Why am I talking about this? So interest is taxed at a minimum of 10% upwards to a maximum of 37% for us federally. There's still state if your state charges income tax on investments. Now, short-term capital gains, that means if you bought a stock and sold it within 1 year, you'd be responsible for short-term capital gains, which has the same tax rate as interest, as everything else. Now, long-term capital gains and qualified dividends have a minimum tax rate of 0. So if you make very little money in a calendar year, you may not be responsible for any taxes. It might be 0. And the maximum is 20%. So if you have a lot of money, which one of these 2 would you rather have your tax rate be? Probably even if you had a little bit of money, you'd want to have long-term capital gains or qualified dividends. Now, inside of a Roth IRA, all of your gains are tax-free. So for the next 3 ETFs, they're going to be either in the short-term capital gains interest and qualified dividends category, but because they're in a Roth IRA, none of that matters. So these are the more tax advantageous ETFs to have inside something like a Roth IRA to take full advantage of getting a much lower tax rate versus what you would be getting in a regular brokerage account. All right, so we have HDV, which is the iShares Core High Dividend ETF. Now this has about a 4% yield. It has been relatively weak this year. As you know, tech's really strong, but banking wasn't. And this is the total return. It's actually negative. So it's a negative 1.8% year to date as far as with dividends reinvested. So it's pretty bad. Now here is its comparison. As you can see, this is heavy in dividends. XOM, which is ExxonMobil, VZ, Verizon, J&J, Johnson & Johnson, ABBV, which is AbbVie, the pharmaceutical company, and CVX, which not CVS, this is Chevron, the oil company. So oil, pharmacy, and telecommunications all hit pretty bad this year, so that's why it's such a bad investment results. Now its beta is less than the market, which means it's more stable than the market. As you can see, it only lost about 0.2% for this year, so it's kind of stable even if the high flying or high weighted stocks have lost double digits as far as from J&J down. ICF, this is a REIT ETF. So REIT is a real estate investment trust, and I do have some videos on the channel talking about different REIT stocks that you can invest in. But this one is an ETF, and its yield quite low at 2.84%, and it does have some pretty light volume. The average volume is at about 240,000 per day. This is its total return, so ICF only 1.75% over the course of this measuring period. And here is the top 10 holdings, which is 62.5% of the asset. Now I changed over to this illustration of the different types of stocks just to give you guys a different feel. If you like this way better than the way I had it manually written in, let me know in the comments so I can, for further videos, put this versus having the typed in one that I did. So as you can see, they have a lot of stocks that I covered here on the channel: AMT, PLD, Equix, Crown Castle, Welltower. A lot of these companies, they're real estate investment trusts that have a underlying layer of utility. So Crown Castle, they have a lot of they own a lot of the cell phone towers. Prologis, they own warehouses, and their main tenants are warehouse type companies like Amazon. So they are a very, very reliable company, and they have a large stake, or at least the ETF has a large stake in the company. 8.13% of the holdings of this fund are allocated toward PLD. Even higher is AMT, right? American Tower Corp, which is the same thing. They own cell towers. Last, we have CVY, which is multi-asset income, and this has a 5.35% yield, the highest that we have on this list for the Roth investments. Its average volume is very low at only about 8,800 per day, so it doesn't trade very much, and has a pretty high expense ratio of 1.06. So a fund like this would be for sure if you needed just income and you're willing to live with the 5.35%. You are more looking at this fund as a asset income generation than appreciation. So this fund does not make very much money over the course of even holding it for 5 or 6 years. Interestingly though, this fund performed quite well as far as the annualized return, probably because it was really beat up last year due to all the different things that happened in 2022. It had an annual return of 12.75% this year, so it's doing quite well. Here are the top 10 holdings, and most of the holdings on here are companies that you probably heard of. Allianz Resource Partners, Williams Sonoma, they make like kitchenware. Dick's Sporting Goods, I have one of those nearby. Phillips 66, Simon Property Group, which is another big real estate investment trust, and they also hold some preferred notes, which probably is why the company has much more stability this year rather than last year, when bonds took a pretty much beating last year. Alright, so that sums up the list of the top 6 Roth IRA funds according to the article from US Investing News. If you like this kind of video, let me know. I'll be making more we can break down. If you want me to be more specific on a particular thing, also let me know. We can go over different ratios like the Sharpe ratio or how to pick a good value stock and those types of things for your investment inspiration. And I hope you guys have a great rest of the day, and I'll see you in the next video.